Good morning, ladies and gentlemen. Well, another pretty good week for risk. We closed the week at the highest score. We started here and we closed at exactly the same score, but the highest score of the week, even though we had a couple of dips. Nothing too exciting happening, but as you can see, these moving averages are constantly coming together. And sometime next week, I anticipate that the daily model will actually go to risk on. We probably have another 2 or 3 weeks to go until the weekly model goes to risk on. And I anticipate that next month, i.e. in August, we will have a move to risk on even in the monthly model. So to me, I see no reason not to be long of risk and buy dips. Still a strategic market, but I think that we will be in SPY very, very soon, and then I anticipate that we are going to get one of these periods, a long period of risk on, where risk assets outperform fixed income assets for probably the best part of a year or so. Deviations, I think, tells the story fully. We have turned the center line. You can see up here where the various values are. We got into the red, we backed off, but all we are doing is basically allowing these bands to widen, and we might be doing one of these periods whereby we slowly and steadily rise, and the market goes up, of course, with with setbacks occasionally. I see no reason at the moment to fight this trend. There is absolutely nothing there that it's telling me in spreadland or in any other indicator that I look that we are about to have a nasty move down. SPY is basically the totality of various components. The components which are most interesting to me are actually XLU, which is anticipating not being interesting anymore, i.e. that people want to shift their assets into higher risk categories, and really the most interesting one to me is XLF and XLI. XLF is stabilizing. People are so bearish of XLF, aren't they? And XLI. They have been selling it to, sort of on a spread basis, on an absolute basis, on every basis. And that is when you can get some really big surprises. We are coming up to earnings. The bank earnings start next week in earnest and will be finished in about 12-15 days time. The surprise could come from XLF and also from XLI to a lesser degree. We could easily go and test the around the 25-26 area in XLF, and that to me tells me that it could very well be a rotation out of technology and into these sectors that have been out of favor for such a long time, which really wouldn't have such a huge impact on SPX per se. And that is why I think SPX is going to be contained in probably a 3% range next week. But you could see a vast outperformance in XLF and XLI. I think if you want to be long of risk, it's much easier to be long of XLF and XLI because they give you a very good risk reward. Closes after, say, JPM earnings below this line are going to be quite bearish. and otherwise, I think we could easily test this 25, 26 area, which gives you a wonderful risk reward. You're talking about 3 to 1 at least. Bondland is not giving us many clues. We're just not breaking above 53, which I would regard in the 2s, 10s as a trigger for aggressive risk on. We are just meandering about in a 2, 3, 2, 3, 4 tick range, which really is good for risk. I mean, it's not bad. To see some risk off, I think we would have to break this 35 to 30 area, and I don't think there are any indications of that. But when you think about it, what is the aim of the Fed? The aim of the Fed is to stabilize all rates, short and long, at much lower levels than they were before the crisis broke out. And having done that to bond yields, then to bring in the spreads against corporates, which then in turn supports equity prices and risk in general. As long as things are stable and volatility is very low in bond land, that reduces volatility in equity land, and once volatility in equity land is reduced, the VAR, the value at risk that various funds use, decreases, and therefore they have more room to add to leverage and basically flood the equity market with their liquidity. Exactly what the Fed wants. So as long as this spread does not break below 35 to 30, I think that this is mildly constructive for risk. The same can be seen in Germany. This is the bubble, which I prefer to the Bund because it's cleaner. Look, I mean, tick perfect, basically. It spent the week exactly on the support levels. It's meandering in the middle. It's doing nothing. That is really supportive of risk, as I've argued. I don't think we will see aggressive risk on until we start breaking below the minus 60 level, and then here trade in this sort of minus 53 to minus 60 area. I anticipate that's going to happen at some stage. But while the ECB has the same aims as the Fed, i.e. kill volatility, keep rates low, help risk through a combination of those factors, I see absolutely no dichotomy between rates staying in this range in the bubble and mild risk on in the DAX and the stocks. This is TLT, and let's be fair, it's not like TLT had a bad week. It's quite a bit higher than the close of last Friday, a couple of 100 points. It's wonderful as far as the Fed is concerned. This is exactly what they want to see. They want to see it in this range up here, stable, with low volatility, and that is exactly what they're getting. The market is not fighting the Fed. The market will start fighting the Fed and will go into aggressive risk on only below 162.05 on a weekly basis and sustained. But look at what these Bollinger Bands are doing. They're coming in. They're saying that the market is going to be in this range, between, say, 160 and 170 for several weeks. Exactly what the Fed wants, and that means that incrementally people will be buying risk on dips, supporting the market, and also means that volatility is likely to remain low and to be a sell on spikes. And the dollar is actually cooperating beautifully with the Fed. I'm sure they don't want a higher dollar because that tightens financial conditions. They would like probably a slightly softer dollar, and that is exactly what they're getting. The dollar was lower by, I don't know, 40, 50 ticks on the week, and is, it's looking more and more toppy, isn't it? It's not even attempting this 98.50, 90, 98.30 to 50 area. Absolutely no impulsion to go there and give us an opportunity to short it at really good risk reward levels. It's, look at it, this is a weekly chart and it's opening these Bollinger Bands, and in several weeks' time they'll be down here. I'm convinced that their intention, that their wish, is to drive the dollar not a lot lower, but somewhere around this 93 level. They would be very, very happy with the dollar down to 93, I reckon, and that, I think, is the path of least resistance. It might take several months, but I think 93 will be seen. It's what everybody would be happy with in central bank land. That would provide even easier conditions and more appetite for risk. Yeah, I think it's as simple as that. I think the central banks are hitting a sweet spot, and the market is following them, sees no reason to argue with them. It's content to pick up the pennies that the central banks allow it to easily pick up, i.e. the low-hanging fruit. The low-hanging fruit is a stable bond market, stable to declining dollar, and slightly higher risk prices. Passing on to risk, I want to have a look at the Nikkei after many weeks and months since I've last shown it to you. I've been long of Nikkei for a long time. In fact, I bought it up here, I averaged all the way down, and now I'm slightly above break even. But I like the Nikkei. I think it's going to be one of the better performing markets over the course of the next couple of years, so I want to be invested. I think the Nikkei is showing you the same pattern as the SPX and the DAX and the stocks, more the DAX than the stocks, but that basically dips are getting bought, ranges are getting smaller, and these green candles all around the one dip that happened about a month ago on a weekly basis just shows you that there is no impulsion to the downside in any of these markets. There is not much impulsion to the upside, but that is also good because these markets need time to consolidate. I would love for the Nikkei to stay below 23,005 for another month or so. I think that will give us the impetus to finally break to new highs by year end and trade above 26,000, probably 27,000. That is the way I feel about the Nikkei. I don't feel very different about the other markets at all, to tell you the truth. Emerging markets, I haven't shown you this chart for quite a while, but 45 is the area that they are unlikely to break for several more months. I think we are more likely to have one of these back down towards the 40 area before we go and break above 45. It's same pattern as several other equity markets, i.e. we have nearly completely recovered from the panics that we had. We are now in a consolidation and accumulation phase, say between 42 and 45 for a while before we start breaking up. There is no reason to sell these markets aggressively or be aggressively short. Why people insist on being bearish when all the evidence is against them is beyond me. I will now show you the DAX and then finally the S&P, but all these markets seem to be in accumulation phases, and at some stage there will be a breath thrust higher, and we will just keep on trucking probably until year end. The DAX and the stocks are, parroting every other market. They closed basically where they opened. No difference whatsoever on the week. They keep, the DAX keeps on failing at 12,800, which is not a surprise. You can see the pattern. It takes a long time to build enough energy to break 12,800, and then even when that happens, it returns to it several times. You can see the Bollinger Bands are doing on the weeklies exactly the same as they're doing on the SPX and the EM and Nikkei. It's all saying that it's going to be contained. 12,300, 13,000, 13,200, 300, whatever. It's not going to go. It's not going to go tens of percentage points. We're talking about a couple of percent here and there. It's turning from a positioning market into a trading market. You sell the rips and you buy the dips. You probably buy the dips much more aggressively than you sell the rips, because you have to have something in position all the time. But that is the kind of market we're getting. We have transitioned from that kind of oh my good God, the world is coming to an end, because it's not coming to an end. This pandemic will end. It'll probably end in 6 months, 9 months, whatever. Pandemics always end. That's what happens. They end. So the market is doing exactly what I'm basically expecting it to do, and that is, given the fact that the central banks have so aggressively intervened, and they've actually brought forward this period, is that all dips are going to get bought, and slowly we are going to go and try to attempt to make new highs. Going through all the time frames in XPX, the market is basically very, very contained. It needs time though. As you can see, this is a 195 minute, which breaks the day into two, and then we have a daily, a weekly and a monthly. We still have this the 200 period moving average here moving lower. So the market needs time to turn this final moving average higher, but that doesn't mean it has to go lower to do it. It just needs time. I think next week 32.14 on the INX is almost guaranteed, but I think that's probably going to be very, very toppy. As you can see, these moving averages are, they're beginning to establish themselves. Every time we take a dip to the lower Bollinger Band, to the middle of the Bollinger Band, or to these moving averages, the market is supported. So I would expect no lower than 31.27, probably even no lower than 31.55 for some time, and then go up and test the 32.14, and we might even go up and test these highs around the 32.30 area, and maybe even break them a little bit before we come back. I think the market needs time, but all dips are supported and will continue to be supported. On the dailies, same picture. We have the higher Bollinger Bands here. I don't think we're going to break them in a hurry. I think we are about to do something like this. Something that we did from, say, January it needs time. We want to basically keep on bouncing off this pink line or the red line, and really that means that the market is going to be supported around the 31.10, 20 level, and have pretty good resistance between 32 and 32.30, 40. It's telling me don't get excited either way, but be ready to buy the dip. I think we have the ideal position being long of long-term calls and short of higher strikes in shorter-term calls. I think that's going to pay. In terms of the the weeklies, I think we have very, very, very good resistance at 32.21. I would not be surprised to see several weekly attempts at it before we are in a position to break higher. And if we look at the monthly, actually what's interesting is that the highest monthly close we've ever had in SPX is 32.30. And that is precisely where last month we stopped. I would not be surprised to see another attempt at it, but I don't think the market is really strong enough yet to break the highest monthly close we have ever had in SPX. We would really need a lot of help from XLF and XLI, and I will address those before I leave you. Here we have XLI and then XLF on a relative basis, ratio basis against the S&P. These lines go all the way back to the panics that we had in 2009 and then 2013. And we are actually below them all. But look how far away we are from the moving averages in both XLI and XLF. Even if XLI and XLF are going to take an awful long time to recover, which makes sense, because XLF is really handicapped by the lower rates that the Fed has induced, and it wants to have a relatively flattish yield curve, i.e. not a huge difference between 30-year bonds and overnight money, because that wouldn't suit it. It wants rates to be low so the companies can recover. It tells me that that most of the bad news probably in both sectors have been discounted. With these earnings that we have here for the second quarter, this might be the absolute trough in earnings for both sectors. So it would make sense to me to see next week some kind of recovery in both XLI and XLF. And together they're about a third of the quarter of the S&P. So if they recover 4-5%, that will be enough to make even if there's some rotation out of tech and out of other sectors, that should be enough to make us go above that 3200 level towards the 3225. I don't see much more than that for the time being. I think even if they're going to recover substantially over the against SPX, it's going to take an awful long time, isn't it? An absolutely awful long time for both, because for XLF these rates are not going to change for a long time, and for XLI it's going to be an awful long time before there's synchronized world growth in the industrials. So I think this is probably a bounce, something that is going to be short term, but could juice the SPX by 2 or 3%. Let's say a couple of percent. I'd love to see it around the 32.25 level again. That is it. Thank you very much indeed. You understand my thinking. I think the path of least resistance is still up in risk, but it's not going to be extreme. It's not going to be very strong. And basically the level that is key is still in volatility, I'd say. Let me show you that very quickly before I go. It's here in the weekly vol. I think this level around 2272 is the key. If we see vol below 2272, we're going to have more aggressive risk on. But I don't see it for the time being. I think we are going to need several weeks of lower ranges, and look how small the range involved was last week, really. We haven't seen that for a while. That should eventually help us to crack 2272. Let me move this chart so you can actually see that level. I apologize. Here it is. 2272 to me is key. Below there, and we have a breadth trusts in upside in risk, because if we crack 2272, you will see a whole load of liquidity coming in, coming into SPX. As simple as that, but I think it's going to take some time, really trading between the low 30s and that 23 level, several weeks before we start cracking it and going back into the teens in volatility, and that will be the sign for aggressive risk on. Thank you very much indeed, and tweet you on Monday.